good evening and welcome everyone to the last episode of season 2. And for us, the season starts from April to March. So this is the second consecutive financial year, which we call it as season 2, and we are in the last episode. That's episode number 12. Uh, Indeed, I mean, thank you for everyone joining in to this session. One of our commitment at Almus has always been to spread the knowledge, create the market awareness on various topics that really matters to the financial market participants. My name is Maulik Shah, one of the co-founder and CEO of Almus Risk Consulting, and indeed my pleasure to welcome all of you to this today's session. This session would not be possible, and this is something that I can keep telling and boasting about it, but for all of you who are really participating every session. I mean, after every session we have this conversation, do we really go for a next one or not? But believe me, there are few who are consistently participating. We get the feedback, and that really encourages us to come back every month and every episode. So really appreciate all of you. Second, key participants in this entire webisode series, and I really want to acknowledge and thank each and every one of them. We have one today with us, Rohit ji. And Rohit ji, I can also tell you, over last 24 episodes, 2 seasons, 12 episodes, we have had number of speakers, and all the speakers really put in the efforts in not just preparing, but also sharing their insights very freely. So, which is something which we consider it as a privilege, because all of you really put in that kind of an efforts for really, sharing. I mean, you are the expert of the field. And when you share your insights, it really matters a lot to the people who are really, hearing your insights. So thank you, Rohit ji, and all the past speakers who have really made this entire webisode series really effective, successful, consistent. With that background, let me just set the brief about today's topic. Now, today's topic is inside the theme Roadmap to Current Account Surplus. In this particular season, we conducted 50% of the episodes, which are 6 episodes on this particular theme. Now, why are we stressing more on current account surplus? Just to little bit background, we as a country are current account deficit, except 1 year, I remember 2002 or 3. It has been consistently current account deficit for last 2 decades. To an extent that it became a cause of concern for the government. Why? Because India is a growing economy. We are one of the fastest growing economy. And what if import-led growth is really impacting our external balance? I think with that concern, a lot has been done by government, market participants, including some of the private enterprises, be it a PLI schemes, be it government initiatives through FTA and various other measures. We have seen some green shoots. We have seen pockets of few sectors really doing well. There are some who are in the phase of taking off the growth, and I'm talking particularly about the defense, semiconductor exports, and those are the sessions that we conducted. The first episode that we picked up under this scheme was service sector exports. Now, GCC, Global Capability Center, I mean, most of you know about it. It's really picking up. Service exports is one of the big contributor to the current account. Now, this is what we have been focusing on, and what will it take for us as an economy to convert from a deficit to a surplus. Now, today's episode is slightly different and unique. Why? Because all the 5 episodes, and I'm talking about GCC, service exports, jewelry exports, the textile exports, the semiconductor exports, and the defense exports. It has all been focused on exports and the growth of exports. But today's episode, and thanks to Rohit ji, we could put this together, is on one of the most critical item on the import sides, contributing 20% of our import bills. And if that also is some way substitute, I mean, we are able to replace, substitute, reduce the import content, that also equally contributes to the current account surplus. So with that, I'm just going to first explain the flow of today's session, why it is so much of an importance. Give or take, on a $700 billion import, we are talking about a $150 billion of oil import bills. And today we have with us the speaker who has been into the thick and thin of this, an industry expert, someone who has been through his entire career dealing with the sector from, whether it is IOC or whether it is CPCL, where currently he's a director of finance. And it is indeed my pleasure. And Rohit, thank you so much. I mean, whatever thanks I may say, but it is really not enough to have you as a speaker. Indeed, a privilege. Allow me to introduce Rohit ji for all our today's participants. Rohit ji is a chartered accountant and he holds a master degree in business administration. He's a gold medalist from Xavier Institute of Management, Bhubaneswar. He started his career in IOC, Indian Oil Corporation, in 1997. He has a multi-unit experience having worked in refineries of IOC, which is at a different location, Guwahati, Vadodara, and Mathura. He has more than 10 years of experience in corporate finance. He has a team lead for multiple change management assignments in IOCL. And prior to joining CPCL, he was the Chief General Manager, Business Development Division, Head of the division, and IOCL Corporate Finance Office. And in CPCL, he heads one of the most critical role, and he's a Director of Finance at CPCL. So thank you once again and welcome, Rohit. Now, on the flow of today's session, what I'm going to do, I will take you through first the few presentation slides just to talk about the few statistics of the current account deficit, and will bring down our focus of discussion on the sector, which is the oil sector. And within that, what really has happened in the last couple of years, there has been a completely changed dynamics that we all deal with. I will come to a place where I will then hand it over to expert. Rohit ji will take us through the dynamics, the oil dynamics, the India's potential, a lot more insights from an inside out perspective. So I will hand it over to Rohit ji, and post Rohit ji sharing his opening remarks, we will engage into a Q&A. Now, my request to all of you, there is a chat box available. Feel free to use the chat box at any point in time. We don't have a separate dedicated Q&A session. You come across any thoughts, any comments, any questions, feel free to put it up. I'll pick that up from chat box and place it to Rohit ji. So this is an open forum. I mean, expressing your views or comments, feel free to do that. I will have my set of questions, which I'll place it to Rohit ji at the end of his opening remark. So that's the flow of today's session. Let me begin by sharing my presentations, which is just giving an overview of the current account deficit and the sector. I guess you are able to see my slides. Harshul, just say yes.
Yes.
Okay. So oil dynamics and India's potential as a key player in global oil market. Just a brief number. While I know I'm talking about 23, 24 numbers, 24, 25 numbers are better than what it was in 23, 24. We talk about a current account deficit of about $78 billion. Then I think this year it is even lower than that, less than $50 billion. Numbers are still out, yet to come out. Broadly, I can tell you 1% of the GDP, give or take, we are about 3.6 trillion economy, or 3.8 trillion, and 38, 40 billion or $50 billion of current account deficit is not really worrisome. And this is something which is significant improvement than what it was envisaged 3 or 4 years back, due to multiple reasons that I talked about earlier, PLI and various other schemes. Now, let's come down to oil. We talk about total exports as 437 and imports at 677. Now, there is a significant uptick in the service export that I talked about, which is $339 billion, and a reduction of imports of 177. So in a way, what is really happening is that the expanded trade account deficit is getting sufficiently cushioned through an increased service surplus. We are a service surplus economy, and that is really giving a lot more cushion to the trade deficit. And therefore, our current account deficit of $78 billion current year is much lower. And I'll come to the import component of the oil. Just remember a number, $677 billion. This is again broadly how the numbers have moved over last 15, 20 years. Total imports, total exports, and a current account deficit. We had dipped in 2022 in terms of the deficit, and slightly again inching up. Inching up is a reduction of the current account deficit, which is positive. Broad numbers, again, whom do we export to and which are the export items? Now here you will find some bit of a petroleum products also, which is roughly around close to, I would say, all the numbers are similar more or less, but I can tell you in terms of the numbers, we are at a 5 to 6% of our export basket, which are through petroleum products exports. And we will talk about that in the next session as to what the opportunity lies there. And as far as the country-wise concern, USA, I mean, where others are number of countries, broadly within the country, USA constitute a major portion. And then you have Netherlands, UAE, China as other export countries where we import. Likewise, on import side, we have China as the biggest supplier to country other than UAE, USA. But when we talk about the overall imported items, 22% is what really constitute the crude oil import, which is where on a $677 billion, we talk about close to $150 billion. And that's the topic of today's discussion. There are few slides which I will talk about as a breakup of oil sector, and which is where the expert comments will enlighten us further as to what's really happening. But before that, this is the number, $132 billion, just a number to remember, crude oil, and $47 billion. So that's about 10%, and not 5.5%. 10% is a number, which is the total export of petroleum products. And we are close to around $470 odd billion as a total export. So that's where it is 10% of the total export basket. India is the second largest crude oil importer, sixth largest refined product exporter, and we import roughly 90% of our refinery needs, and crude imports are almost 36% in a decade. However, there are significant shift in the crude imports from in the last 2-3 years. This is specifically post Russia-Ukraine crisis. Our imports from Russia has significantly increased. And I think that's reflected in this chart. As you can see, the red bar is Russian Federations. If you really see the total import from where by origin, you will find there is a significant increase in the Russian imports, and that's one notable feature. We'll talk about that in the session. Coming on the export sides, apart from $47 billion export, there are other components which are part of the petroleum product category that totals up to $70 billion. Again, brief details of where these exports are being added to. And again, it is important. Why am I highlighting this? Because in the next session, Rohit will talk about, how even that export of petroleum products are also undergoing what is a mega trend that's really happening in the constituents of country, product, categories, etc. And this is the India's refining exports by country, by product. Again, this is the projections right up to 2030. It has a relevance in terms of what product category, which was there as a exports in the last couple of years, will that continue? Will that change in its pattern, which is where this chart and data is relevant. Similarly, even the light distillates exports. With this brief numbers, just a few pointers to remember. We talk about an oil import on one side, the export opportunity on the other side, how there is an overall trend emerging. What was last 2-3 years? Will that continue? There are a number of areas where Rohit ji will share his insights. With that, let me pause. Over to you, Rohit ji. Please.
Good evening to all. I think Maulik, thanks for inviting me to this discussion. And I think you gave a very detailed introduction about me. But, I hope in this discussion, today's discussion, some of those relevant experience come true, and it's useful to our people. So let me start like this. Oil continues to be the pivotal driver of global economy, influencing not only energy security, but other related very important items like technological advancement. And now the fulcrum is, we're at a point where sustainable development is at the fulcrum. And, this oil and gas will drive that development as well. With India's growing economic stature, India's role in global oil market is expected to expand substantially over the remainder of the decade, fueled by strong growth in its economy, population, and demographics. But let's start. Let me bucket this into few areas and then take one by one, and then we'll deliberate further. So let me start with global energy landscape in India and India's position in that landscape. As per IEA, International Energy Agency, oil contributes to 31% of global energy consumption. And India is the second largest oil importer in the world. With India's growing demand, backed by industrialization, increased transportation, rising middle class, as of now, India ranks as the world's sixth largest product exporter. So what has happened is not only in a consumption pattern we are high, but because of the consumption requirement we have, the kind of capacity we have created, we are a dominant force for exports. And we'll dive a little deeper into these going forward. So on a statistics basis, India's imports are around 5 million barrels per day of crude oil, with close to about 90% to be precise, 84% of this sourced from international markets. Country's oil demand is projected to grow at 4 to 5% CAGR in the next decade. Now let's move to future evolution of country's oil sector, the broad trend. India will become the largest source of global oil demand between now and 2030. While growth in developing countries or developed countries and China initially slows, So what I'm saying is maybe in some of the other countries, the growth will taper faster, but the growth may slow, but it will go longer here. The earlier projection was that, others may peak by 2030, India may peak by 2040. But with the last few months development and the, changing focus of US and other developed countries, you don't know this to 2040 becomes 2050 for India. So others, the slide may be little, but the period for India may be a little larger. And that may be a blessing in disguise, we don't know. So what will happen, we'll get more time to transition in a very profitable, sustainable, economical way, and maybe we'll be able to lead in some of these space. We'll go to some of them. We'll touch upon some of them. And what will be those driving forces where we say this will happen in India is urbanization, industrialization, emergence of higher middle class, the wealthier one, because mobility will become a key to them, added with tourism, greater access to clean cooking. So another unique thing in India is, the clean cooking drive, the LPG drive, that has tripled the demand consumption in a very short period. We are heavily importing LPG, and so that becomes a base. So the newer base is a quite larger base, 3x base. So that's clear. And then that ambition of using clear fuel will not go down. So all these will expand oil requirement. And if you again put it to number, maybe 1.2 millions per day will be the additional numbers, by 2030, taking the consumption from 5 to above 5 to maybe 6.6 millions per day and like. Now let's touch upon demand and supply. The massive industrial expansion, leads to gas oil, or we call it diesel, demand, which is the single largest source of oil demand growth in India. And this will continue to rise, till 2030. We expect 4 to 5% growth. Another significant component is jet kerosene. So, though by looking at kerosene, we may feel that kerosene getting phased out and replaced by LPG, but ATF is nothing but jet kerosene, the same leak. So, with aircraft and with so many more cities connected by air, this is another area. ATF, aviation turbine fuel, which is a kerosene gene. This will expand drastically, and with the country and the companies taking strides in SAF, sustainable aviation fuel, this is not going to die down. Rather, this is going to increase much more. And as we might have seen recent development, not only the domestic player in the aviation industries are growing, expanding. Recently, I came across news where some of the foreign players now are eyeing, new players are eyeing to enter our market. So, that is the scale of this sector, and then it affects the jet kerosene demand. And, above the normal 4 to 5%, jet kerosene can can take a growth of close to 6 or maybe above that because of this demand. Certainly, the MS, we call it gasoline, the petrol, that may be a little slower, maybe about 1%, and that is also largely dependent because a lot of electrification happened in the two-wheeler segment. So a lot of EVs will start coming. They have already started rolling in, and that is the first thing that will get affected. And MS may taper down, but still it will continue. The peak will take some time to come. LPG we talked about, again with large base, it will continue to grow because one of the connotation is this is a clean cooking fuel, and the government is running a large program around this. Another aspect why this is important is we are a relatively small oil producer, close to 90%, to be precise, 84%. We are importing outside. Our domestic production is hardly 13%. So that continues. That also constitutes to be an important factor here. Now let's go to the next area on the development that is happening in refining. How the technology and this development will also affect the net import or exports. So the domestic oil demand is heavy. We have discussed about that. Over next 5 to 7 years, maybe 1 million barrels per day, new refinery capacity is coming. So if you see, there are companies where we have announced or we are pretty close to large scale brownfield expansions, significant. There are companies who have announced pretty large greenfield projects, including larger petrochemical penetration. So all these will come on stream, and I think with the discussion we had, diesel, jet fuel, this will sustain, and because we are peaking at much later than other countries, maybe 2040 and beyond, that is how this distillates will hit the market. And again, one correlation: our existing consumption gives us that leeway for export. They coin a term switch supplier, switch exporter. So if there is a problem somewhere, because we have large capacity, we become the preferred destination to fill up that gap, to fill up that volatility. And that has happened even the last crisis, the geopolitical crisis, when there was suddenly a demand-supply imbalance or the sourcing starts changing, then India became the preferred destination, and our export, went up 20% more than what used to be there. So even that secured supply source, that will also be a important factor when exports in this sector, we talk about the exports in this sector. So again, in this, with respect to refining development, beyond this capacities, I said, the spectacular economic growth story, will bring these capacities, but it will also bring challenges, and another pertinent aspect I feel is security, energy security. We agree, disagree. Energy is another commodity where energy security is pretty important from multiple angles, from a consumer angle, from a market angle, from demand-supply balance angle, from a safety, security, government's policy angle. This is pretty important. So again, that will also be a critical factor that the capacity in India remains adequate and sufficient, and we are not, we are able to handle any kind of geopolitical disturbance or any kind of imbalances, and it doesn't hit us in the short term. So those kind of priorities will also be there. What has happened in the recent past, what we talked about is that crude oil import. So another aspect of crude oil import, let me explain how it happens. Irrespective of the companies, private or public, the oil import in India happens on a landed cost basis. So it is no preference of US crude or Russian crude or Middle Eastern crude. What has happened over a period of time? All of these companies have made capabilities, technical capabilities, where they are able to process a large basket of crude. They are able to, they have widened their basket. So what they are doing is they are looking for opportunity crude. So at a landed cost basis, at a yield basis, at a landed cost yield basis, what is the per unit realization, per unit benefit that they can get out of this crude? And they are able to change a large basket. So in this opportunity market today, X country may be cheaper, or more beneficial. Tomorrow, Y may be more cheaper. So that days have gone when you are dependent because of design on particular crude. You can't process unless you get 30% of this crude or 50% of this crude. And that has also changed one of the landscape. Earlier, if you go back a decade or two, you will find 80% used to be term crude. I feel it has well fallen to 50. Most of the cases has fallen to 50. Even that 50 is not dependent. Again, that is
what you're saying, and just to understand a little bit more. Today, my decision to import from a source is a landed cost criteria, not the category of the product that I import, which earlier it was largely dependent on that.
Yes. So earlier it was largely dependent on the technology. See, the refinery comes at a particular time. It is with a particular technology. Licensor. There is a yield pattern. So based on the yield pattern, they can process limited type of crudes. So that was what was governing, and that is how 80% of the procurement used to be term. Because once I do not have leeway, I have to close because I have to secure energy. But because that basket has expanded, so what these refiners are in a position now, they can process a large basket. This large basket is coming from a larger diverse source. So now they are in a position where they are looking at yield.
Got it.
Product realization.
It's a function of how I have transformed my refining.
Yes. And that has not happened to a public or a private. That has happened across at various degrees. And that is how the dependence on term, which was as large as 80 a few decades back, maybe close to 50. And even in that 50, they might have a leeway of some percentages. That's a big thing. That is how, when these kind of oil shocks are coming, it is not jittering us. You need to fine tune it. You need to adjust it. And within a short period, people are able to adjust. And that is how the term, rather than a market, the spot is driven by, they call it opportunity crude. So at that point of time, whatever is opportunity crude, they're able to process.
So we are more agile in a way.
Yes, they're more agile. They're able to switch seamlessly to certain percentages, 30-40% between crude grades, between source, and and certainly based on delivery. So even if I'm comparing today, maybe a 3-day shipping from Middle East and a 30-day shipping from US, I'm not bothered because I'm comparing at landed cost.
Got it. Very important.
So let's move to the next topic, which is worth discussing, is government's key initiatives and transition to cleaner fuel. We all know EVs, energy efficiency, these will be the key words going forward. And I'll tell you what is energy efficiency. There is a item called fuel and loss. So suppose I'm processing 100 barrels of crude, I don't get 100 barrels of product. Let me take a simple example. Suppose the fuel and loss is 10. Losses are minimal, maybe less than 1%. Internal fuel consumption is say 9%. So what I'm getting is I'm getting 90 as product. Suppose through technology implementation and through efficiencies, I'm able to reduce this to 8%. What happens? With the same 100 barrel of crude, my product is 92. So what happens? My import bills comes down. The second aspect, suppose the middle and light distillate earlier used to be 70%. Now with technology, crude mix, slate, I'm able to take that to 80. So now, again, to that extent, my crude requirement is less. Suppose I'm able to adjust blends. All refineries are at different level, different capacities. Suppose today I have, semi naphtha. It can be, it can be blended with MS, and MS can be done. So it may go to a CCU in another refinery. It can be blended, MS can be prepared. So what will happen? I'll not export naphtha, a lower value product, and I'll less import MS, that is petrol, or I'll export petrol. So again, what is happening is, it is changing the dynamics of import and export both. It is adding value-added export within the same quantity, and it is reducing crude for the same quantity. Suddenly with growth, I'll take more crude. So again, these kind of technological advancements is affecting largely. Now let me come to the other point.
So before that, just few understanding point. So what you just mentioned is a function of what government did those initiatives, and is this something which is largely driven by government, or is there a private enterprise into this initiatives? How does this entire thing function?
I'll tell that. So here there is no direct intervention by government.
Okay.
Only there is an encouragement where the emphasis is on newer technologies, making it more efficiency. And then, even this net zero. What is net zero? Net zero is a point when you have to declare when your carbon emission will be zero. Your carbon accounting will be zero. We know practically it can't be zero. So what is the first step? The first will be reduction. So what will be that reduction? You will introduce LNG into a fuel system. So fuel will come down. What will come up? Your product will come up. Product slate will come up. You will bring in technology. Yield will go up. So even though there is a policy called net zero, the steps will be reduction in fuel loss, reduction in carbon footprint, offsets. The last leg will be offset. We'll focus on scope 1, scope 2. We'll start parallelly focusing on scope 3. Product formation. All this will force companies, private and public, at a corporate level, at an enterprise level, at a business level, to look at technology, look at efficiency. Never before. The efficiency and the urgency will be like never before. Otherwise, there may be a risk of a carbon tax. There may be, risk internally or externally. So it is always better, to trade it in a profit center way rather than a cost center way. So that's one aspect of it. Let me go to the second direct policy intervention of government and how it is affecting this oil sector and how it is affecting import and export. We all have heard about ethanol and ethanol blending. This country took a lot of time going to a 5% blending level. We went to 15. Our target is 20. And the target of 20% ethanol blending has been preponed by 5 years, and we'll be achieving in 24-25. What it does, it means if I'm selling 100 petrol, actually 80 is petrol and 20 is ethanol.
Okay.
So the consequent crude is down. So by processing less crude, by importing less crude, I'm able to increase. So, so 20% ethanol blending means 25% product more. So 20 or upon 80.
Which was earlier 95%.
We started with 0, then 5%, then 10%, then 15%. But the last 10 to 20% has come at a pretty faster pace.
Yeah.
So 10 to 20 is double in that manner. And then we are also targeting 5% in diesel. And then let's look at our LNG target. CGD target is 6% to 15%. LNG use. What LNG will do? Immediately it will reduce your carbon footprint. What will happen? People will start moving to cleaner fuel. So cities will move to LNG, CNG. Rural will move to LPG. Penetration will be faster. Cost will be cheaper. Intermittent losses will be less. Handling will be easy. Safety will enhance. And the impact is what? Impact is I'm expediting net zero targets. Carbon footprint I'm reducing.
Plus reducing or rather faster pace of ethanol and overall reducing the...
Yes. I'll tell you a direct impact. I told you 10% fuel loss. So that is internal energy. Once I switch naphtha or FO to LNG in my internal fuel, again what will happen? Product will come up. Because I'm not burning FO or naphtha out of crude into internal consumption. I'm bringing NG, CNG, LNG, whatever. My products will go up. So again, to that extent, my crude import will come down.
Curious to know, Rohit, what is the trigger for an accelerated speed of shift? It has always been there, right? I mean, why? What has really changed?
No, I'll not say it was not there. It was always there. But certainly, the talk about climate efforts, the international discussion, and the Indian government's resolve to declare a date, 2070. And then every company, large, small, medium, creating their own target has expedited the whole process. And, we must give government full credit for ethanol. No one thought a country like India can go so fast and, for such a large target, which even some of the large developed country has not been able to achieve.
Got it. Help us to convert in terms of the numbers. As a finance person, we always believe in numbers. I mean, we always relate with numbers, not believe, relate with numbers. $134 or $140 billion import boil with this.
So let me facilitate so that you can convert. So normally the MS production is 10 to 15%, 12 to 15%. And now 25%, 20 becomes 25%. 25% is ethanol.
Okay.
So 3 to 4%.
3 to 4% of the oil import bill.
No, petrol, diesel. Petrol, MS.
Okay.
Because ethanol is going to MS.
Okay.
Right. 12 to 15% was MS petrol. So 3 to 4% of the total product.
That is a reduction in the
Yes.
export invoice.
Yes.
And that could be as big as probably any other industry's exports.
Yes.
Smaller exports.
Yes.
I mean, that's exactly in the bigger picture.
Yes.
People don't really realize what it can contribute to a current account surplus.
Yeah. And I'll tell you what are the consequent impact, maybe beyond 3, 5, 7 years. Again, one of the great thing about the MS pool, the petrol pool or the naphtha pool, is these are a right feed for petrochemicals. Even when we talk that the petrol or MS will rise by 1%, it may taper peak a little early. It is not that will become surplus. There will be issues. We need to compulsorily export. No, most of these will go to petrochemical feed. And our petrochemical feed, the intensity is pretty low. The per capita, petrochemical consumption is at 1/10 level, not even 1/10 level of the global, thing. And with our economy expanding, again, that's a great area. So again, this will be a self-feeding loop where this benefit will, change the form. But the benefit really will accrue, and it will affect our import export, and it will affect our CAD.
So that puts me to a related question. And okay, and also for everyone who are there in the room, feel free to put your questions. As I keep saying, it's a free conversations. I'm having a chat with Rohit ji. In case if you also have any points, put it up in the Q&A box. I'll pick it up. In the meantime, Rohit ji, so if we were to put up predictions for the future outlook, you talked about the oil demand supply. You also talked about the increased oil demand moving forward as a country. Urbanization you talked about. At the same time, there are efforts to reduce the dependency. So if you were to really predict the outlook for India, I mean, how do you see the current level where we are, both oil imports and the exports? Is that really going to widen, stay put, or decline?
So let's bring in some facts we have already discussed. We said today it is 5 million barrels per day, and by 2030 it can go up to 6.6. So it is going up. Export parcel will go up because already some of the countries, we are a secured source for them. And what will happen with gradually, some of the small countries, they will, like, look at South Asian countries. They have not added any capacity for the last 20 years. Lanka doesn't have a refinery. Bangladesh can't afford a refinery. So what will happen? So, they have to go to energy transition. So what will happen? For them, you will become one of the secured supply source. So
because you are increasing your capacity.
Yes. So import bill will go. Had we not done this, may our consumption would have gone much beyond 6.6. But along with import, our export will also go up. But what will happen after a point? It will stabilize at that 6.67. So all those additional benefit that we are talking about will come in terms of stabilization. So energy demand requirement will not come down. The petrochemical intensity will go up drastically at that 6, 8, 10% rate. But because we are doing so many things, so that will remain there and will become a secured supplier, secured source for exports.
Yeah, I mean, in a way, you are actually creating a trading hub for the world by way of your refining.
And another aspect that we discussed about is maybe the volume is 5 million today, or 1 million. I'm just taking a number just like that.
Sure.
Within that, the value addition of the component will enhance in export terms also. So if you are exporting naphtha, suppose you are not exporting naphtha today, maybe you will stop exporting naphtha and you will export a petrochem. Maybe you will export a bunker fuel. Maybe a high flash diesel.
Interesting. Again, let me put a related question. Given the positioning that we are shaping up into, both in terms of the demand being the second largest, turning into first eventually, and in terms of the refining capacity, we are actually becoming a significant player in this entire oil play, I would say. Do we then have any role in influencing the pricing mechanism? I mean, is there a
very, very interesting question. Let me bring two different diverse aspects to this. One is, already we are talking about 250 million metric ton capacity of crude processing and related product. That's not small, Many countries combined will not have. But what is unique with respect to this is, I do not have local sources. I still will be 80%, 90%, of my requirement will be imported only.
Yes.
Only because of the technology, because of the flexibility. Now I have more flexibility and I can choose between more. So what I felt is, India being a large consumer, if I want to be a factor who decides price, I feel more than demand supply, it will be, our role, the country's role, the player's role in the derivative market. That will decide this. And sometime back I was juggling with some data. Recently I was looking at some of the data. It will be very interesting. Let me throw some of them. So I scanned through some of the large companies, and some of these companies, a company A has a margin exposure of 4,200 crore per month. Another company has more than 2,000 crore, and the third, some of the largest companies, 1,000 more crore. Margins exposure per month, but their hedging percentage, the large one, 4,000 crore, his hedging percentage is 0.49%.
0.49.
0.49%. The person.
Sir, you are entering into a field which really interests us the most, risk management.
No, but that is interesting. See, if it is another country, he will try to say no, because the import dependence is more, so I'll increase oil production, and that is how I'll stabilize. I'll go to EV, that is how I'll stabilize. I'll go to bio and ethanol, that is how I'll stabilize. But we ignore the role of markets.
Yeah.
Finally, what you are talking about, not availability. Availability is not an issue.
Yeah.
We are talking about at what price things are available.
Yes.
And then not only price, we are also talking about volatility. See, in the last 1-2 years, the price has remained between 70 to 90 or 60 to 90. But look at the volatility.
Yes.
The volatility is so huge.
Yeah.
So now, with your experience, let's discuss about this. What can reduce the volatility and what can bring stability? I feel markets.
Yeah. I mean, you open up the market, have more players to through a derivative
liquidity,
market.
Transactions. Yeah, they can hedge their physical position. The pricing is more like to their actual pricing. All market participants, all these sources, the crude basket, they're able to participate. They have their offices here. They're able to trade physical with financial contracts. People is able to migrate. What will happen? There will be a drastic reduction in volatility. Small players which feel, no, it is not my cup of tea, will become players there. Now tell me, a glass manufacturer, he may be a small manufacturer, but how he's not impacted by LNG price?
Very true. Very
and
true.
Why he should not have access to this market?
In fact, forget why he should not have access. I'm saying those who have an access don't do anything.
Yes, because so you know better that these kind of market is not only product, it is not only liquidity, it is not only availability or knowledge. There are so many host of factors. So the market has to develop and expand in a very diverse and in a very multifarious way. I think it has started. I think it has started. Now more than one exchanges are going into it. They may be at a nascent stage. But I think this will pick up pace faster again because we'll remain the largest consumer. The growth here will be unparalleled. That will force other players to come and create a market here. But yes, the lead has to be taken by us because we are affected the most.
Absolutely. Sir, I can share this. We have on this particular webinar stalwarts who are listening to you. Yashwant Rao sir, who has been part of the NSE advisory board developing that oil product. We have Gnana Shekhar, who himself is a commodity expert. And we keep chatting on the subject as to why this market has not yet really developed. While it's there, it's good, but not many participants.
So Maulik, then maybe off the conversation, we can engage a little deeper. I feel it is the right time that these markets can be developed at a faster pace. And all of us, including me, my company, we can play a role in developing this market. It is, no single person can move this. But together, I think, it's an important place, important time for price stabilization and setting the price.
Yes. Yeah. That's where I think the question is relevant as to, can India play a role in influencing? Answer is yes, maybe through a financial instruments, inviting many more participants.
Yes. So in addition to the physical, the electrification, the biodiversification, the LNG penetration technology, even the financial markets in this respect, may play pretty large role in impacting this item.
So I can share one more thing. We have built a report at Almus, the aviation industry hedging, and very interesting insights. As you come from west to east, airline, the percentage of hedges has significantly come down to an extent in India. None of the airline industry hedges their ATM. And we are still to figure out why, and we can speculate.
And it is a free product in the sense that the volatility, the price changes must be happening every fortnight.
Yeah, absolutely. But we wonder, and you can pick up any balance sheet, like you said, 0.5% hedging. I'm telling you, pick up any airline industry. Because now we have hardly two players, duopoly. Even they don't hedge, and that's really where I think what you just said is so relevant. I think excellent point, but we definitely have a webinar only on this subject, because that's really something probably together with Rao sir, Gnana and all, we can probably do something, probably a panel conversations around what can be done to build the oil hedges. But I think that's an important insight. I want to touch upon a few other points given the time that I have. On the last geopolitical development that happened in the last 2-3 years, we saw a shift. We saw our pattern changing from a few other countries to Russia. We became the oil refiner for the world. It used to get, I mean, how is that really trend shaping up as we speak today? And what the future outlook?
So again, let me draw reference to our earlier discussion. Because of the technological advancement and because of supply chain strength, so we are not dependent on a single source. So the concept has moved to opportunity crude. Because it is opportunity crude, now there are 3-4 different players and basket. They compete for this. See, let me take an example. You talked about airlines. What airlines do? At certain very low cost, they try to book 10% of the capacity. So that they know once I have booked my critical capacity, I know what is the so what they're doing is fixed demand and fluctuating demand. So now what is happening is, because of this, because of any situation, geopolitical or supply demand change or new production coming up or new grades getting in, they all are competing for this opportunity crude space. And we are in a position where we are able to evaluate them on a net basis, on a delivered basis. Now, I must tell you in this again, which can impact price and which can impact this. In addition to government storages, I think the traction for private storages in and around India may also get traction and may start happening.
Okay. So it's a strategic petroleum reserves, something like on those lines.
Yes. So what I'm telling is, already government has started with strategic petroleum reserves. That is from a security side, from a country security side. I'm saying the way it is happening in other countries, even the private players, a combination of refiners, traders, investors, I think it is not far off when private strategic storages come here to take the volatility, the opportunity that gives that is given by this volatility in prices. Prices as well as shipping cost, because we have seen the shipping cost also to be very, very volatile. And once you know that 250 million is their requirement at one place, it makes sense for 1% storage.
Yeah. Interesting. So the advantage that we had, again, from a pure play, a layman's perspective, I think we had an advantage from importing Russia at some 20% discount, which is actually now off, right? We don't have that advantage anymore. Now, does that mean the component of oil import? So today, do we continue to buy more from Russia than other countries, or that pattern has?
So let's look at the market data. Maybe the pricing might have changed, but the sources has not dried up. The consumption has not gone out. So actually, again, though I'm repeating, the crux is same only. Suppose my landed cost is 89. Suppose my landed cost is 88.5. Suppose my landed cost is 86. So what I'm looking at, what is my lowest landed cost today, and what is the other source, which is available on a landed cost basis.
Yeah.
And then I'll tell you one more thing. Because this food basket is going up, even this refinery technology wise, they're adjusting that some of the things which was not earlier they were able to process, they are able to process. So what is happening? Suppose few things were not in that competition, in this calculation. Now they're coming to like South African crudes, African crudes. So tell me, from X country, I was getting Y discount, but from a new source, I'm getting equal or more, and I'm indifferent.
Got it. Similarly, on the export side, I think in the last few years also, one of the geopolitical impact also that we have seen is that we have been shipping more or exporting more to the Russians. European market.
Yeah.
Now, is that pattern continuing, changing, moving forward? What is the trend you see?
So if you again, my understanding, the base level has increased. The base level of export has increased because some people want secure supply. But the volatile portion, the flexible portion will remain. Will remain. And then, as I said, newer and newer countries will get added to it. Suppose country X had a long-term contract of 10 years with Y company. So as soon as that approaches, what he will do? Now he sees India as another place. So next time he will evaluate India with respect to his existing sources. So the core export level, the base export level may increase gradually because your capacity to cater to multiple level of fuels will go up. Suppose earlier we were only exporting naphtha or a little bit of gas oil. Now you are able to, some value-added product also you are able to give. You are able to satisfy his larger requirements. Then his dependence on you and reliability on will go up.
Yeah. So I think
one more factor which will affect both of these, whatever the last 1-2 item we have discussed about, is our location. The way I see the southern part of India, where there are 2-3 refineries and it is a potential for storage, private storages also, is not very far from the international sea route.
Correct.
And then the effort that is coming in Greater Nicobar, you are, I'll not say substitute, but you may challenge Singapore. Some of the international existing hubs you may challenge. So what will happen? Ships will stay there. So bunker fueling demand will go up. So even some of the India off-coast demand will come up, will replace some of the external export requirements. So there are multiple developments in and around which is going to aid this process.
Yeah. So one very strong message that you are communicating is while the dependency on oil may continue by way of imports, however, because of the number of initiatives, efforts, our strategic locations, the refining capacity that we see, the India position in the overall market, the entire ecosystem is only going to go bigger and bigger and bigger. We continue to hold that dominance in a way.
Yes.
Though not the producers, but a very critical player in the entire chain is what I'm hearing.
Yeah, that is what I feel like.
I think we have 5 minutes. I'll just pick one more questions. Something on the global ESG regulations, whether that will have any impact on Indian oil industry. You want to talk about, cover in this session?
See, you talk about ESG. Indian companies have started. They've declared their roadmap much ahead of the country requirement. The country requirement is net zero is 2070. If you see companies from 30 onwards till 2050, almost all have declared their requirements. Second, from a ESG publication side, and the green finance side, you'll find a lot of people are listing their equipment at NYSE and other these kind of green markets. So already Indian companies in that matter have taken a lead and they have started early. And I think with ethanol at 20% and then a lot of bio happening, a lot of feed are getting through bio, and a lot of development are happening to my knowledge in corrosion inhibitor, which is another factor where which can propel bio usage. And bio is something, even I was looking at bio source for gas. They are saying the total LNG import can be replaced by domestic gas. The only challenge is supply chain. How do you aggregate those farmers and those other thing How do they feed? How that it can come to a common greed? Those are so infra challenges are there. But with CGD network expanding like anything, that will become a hub and spoke model. That will become a hub and spoke model.
Yeah.
And then I don't see a challenge. Rather, I feel at certain point of time, we also be a leader in ESG that way.
Okay. Excellent. One last point, sir. We talked about the refining capacity increasing. We also talked about we playing a very strategic and a dominant role. How competitive are we when you look at the global counterparts, the nation that already have those?
Let me assume most of us understand finance. At least for financial understanding. Today, if I'm able to export, can I export if I'm not competitive?
I agree. Yeah.
So what is export? So export is, again, the way I'm comparing on a landed cost basis, the importer is comparing on a landed cost basis, because in this oil market, it is not that products are not available.
True.
It means at an XMI basis, I'm competitive.
Yep.
And I'll tell you some factors for it. The processing cost, we are highly efficient compared to some of the best global players. And see our case, what is happening? We are competitive in such a manner that we are able to import and able to export. So domestic product and export is another way of competitiveness. We are able to import crude and export product and being competitive. So unless we have the technology advantage, unless we have our control over our operating cost, unless we are strong in the supply chain mechanism, product slate, yield, how we can be competitive by importing and exporting and still being relevant.
And is this competitiveness getting extended to the downstream products also? Because that has a larger play in the overall other industries.
Yes. See, the value realization in light distillate, middle distillate, whatever it is, when you go down to the derivatives, those go up by 50%, 100% furthermore. So that much more leeway you have in terms of competitiveness. And one more thing, we must agree, most of these value added down products are import substitutes.
Yeah.
So you'll have the tariff protection advantage as well.
So coming back to our original theme, and given the last 1 minute, I am trying to sum up. One is I can clearly see a lot of excitement, a lot of optimism, a lot of enthusiasm from your chair. That's one thing that I'm getting it. That while yes, oil import bills is always a matter of concern for someone who's looking at the number, looking at that $150 billion. But I think from every brief that you shared, from every different angles that you spoke of, I think there is a larger opportunity. For us to play that role. It is less of a threat and more of an opportunity, is what I'm getting as a very strong message.
And the only addition I'll make here is, see, in terms of energy and in terms of role of oil, actually as a country, we don't have a choice. So when we don't have a choice, you utilize your strength and make your way. And that's what we have done. We have demonstrated. And I think we need to move faster in this respect. Only the development of financial markets around these derivatives will be an additional factor in addition to whatever roadmap we have created.
Excellent. I think very well said. When you know that you can't do anything much, you have a little choice. The best that you can do it is, strengthen this weakest link and create an opportunity. And I think that is coming from, and by the way, just for everyone, Rohit ji is not an engineer. He's not a technical person. He's a core chartered accountant and an MBA. So getting all these insights from Rohit ji is fabulous. I mean, a person like me coming from a finance background could pick things which were much more technical, I would say. And it was a technical subject, but I think you made it very simple. So it was a great inputs, Rohit ji, you shared, and also left one key points to be discussed, which is an oil derivative market, the oil hedges, which is definitely a subject that is close to our heart. We do this for living, and I think we definitely owe to the participants this session, which will curate it. But really, really, thank you so much, Rohit ji, for your insights. It was fantastic, very, very enriching. And to everyone who has been around for last 1 hour.
Thank you all. Thank you, Maulik, and all pleasures mine.
Thank you so much. Thank you once again. Thank you, Arshul and the team. managing the back end.
Thank you.